tax incentives. So I'm just going to spend a few minutes, just giving a broad overview, starting with locations. The main two incentives that are available for locations are cost segregation and property tax. And then the 4 employee incentives. Now, first, cost segregation. In short, this is a tax incentive for anyone that owns commercial property. And I would add people that have done significant renovations. So even if you or your client leases their space, this could be a benefit. Who qualifies? Well, if you purchased, built, or renovated a property in the past 20 years for $500,000 or more. Now, cost segregation is essential for commercial property owners because it allows you to take more depreciation expense, reducing income, and thus reducing your tax burden. So as a taxpayer, this means you would receive a significant tax benefit, and that's money that you can use now. The average savings are about $75,000 for every $1 million of purchase or construction costs. And I can tell you that 92.3% of those who own commercial property in the United States have not had a proper cost segregation study.
Okay.
Property tax. Most companies consider property tax to be a fixed cost, but a review of the real and personal property tax assessment will often result in the identification of opportunities to lower the tax bill, savings in the 10 to 25% or more of the taxes paid. Second, savings identified in the current year are typically realized in future years as well. So clients are always happy when they're able to reduce property taxes. Then we're going to move on to the employee part. So 4 main objectives that we'll look at for tax incentives. We'll start with research and development tax credit. It's been around forever. It actually began in 1981, but in December 2001, new tax regulations enable small and mid-sized companies to be eligible to take this R&D, really a wage-based tax credit. The documentation, discovery requirements were relaxed. The goal was to keep innovation and creativity in the United States and certainly encourage economic growth. Generally looking at $20,000 to $40,000 per year for every $1 million in company payroll. So some may be thinking, Gerald, I don't do R&D, I don't qualify for this. So let me just go down a quick rabbit trail. Think about this. Many manufacturers didn't believe they qualified either. But let me just read a couple of production processes that may be eligible for R&D. I'm just going to read a few. This isn't a full list, and this is from manufacturing. Designing and developing cost-effective and innovative operating processes. Integrating new materials.
Like a process, not something physical.
Correct. So this is just that part is just the operational process itself. But integrating new materials to improve product performance and manufacturing processes. Determining tooling requirements for optimal placement of equipment. Streamlining manufacturing processes through automation. Increasing manufacturing capability and production capacities. Improving product quality. Reducing manufacturing times, optimizing manufacturing processes. I didn't read the full list, but that sounds like what manufacturers do every day, all day.
And I think many of us think of R&D, I don't know, from, mainstream media, popular culture, like it has to be something physical almost, right? It has to result in something brand new, and that's not true. R&D does not have to result in something 100% brand new. As you said, improving all these different processes or creating new processes may qualify. So, and manufacturing these days is an endless cycle of doing that.
Exactly right. Again, I think about R&D and I think, this is beakers and white lab coats, and it's not, that is all. It's possible there are activities in your industry, every industry that you and others on the team are engaged in on a weekly or daily basis that qualify for these R&D tax credits. I can tell you in our experience, over 90% of those who are eligible for it are not taking it at all, or they're taking a very small portion of what they qualify for. So in other words, they're not fully leveraging this incentive or capturing it for their business. So it's a huge area. If you're just read a list of some of the industries that are involved in, you'd be surprised. A microbrewery, brewing beer, they have activities that qualify for
Well,
R&D. So, move next to, I call it WOTC, or work opportunity tax credits. Everyone might have a familiarity with this one. It can bring in anywhere from $2,400 to $9,600 for a qualified hire to a client. Over $1 billion in credits are claimed every year, but it is used effectively by less than 1% of U.S. firms, those who hire in excess of 1,000 employees a year. Now, I'll tell you, listen, when you look across all industries, all sizes, all across the country, 15 to 20% of employees will qualify. The average credit that you capture is about $2,500 on up to $9,600 for qualified employees. Now, if you look at service industries like restaurants or hospitality, certainly manufacturing firms tend to qualify a higher percentage of people and at a higher tax credit. And so we just talk about averages again. The average candidate that you could screen for this brings in $2,500. So if you have 4 job postings, you're potentially losing $10,000 in a tax reduction, not a deduction. We're talking about a dollar for dollar offset against your federal tax liability if you are not screening for these things. This just should be a part of everyone's onboard.
and is that also every year you can reapply, or is it 1 year only?
So for each qualified candidate, one time. So it's only for new employees. But if you're hiring on a regular basis, like the restaurant or that hospitality, then yes, you could screen it. This actually can become an ongoing tax credit for that business. Great question.
Thank you. It's valuable to know.
Now, CARES Act created the employee retention tax credit. The cat's out of the bag with this one. People are Googling this one constantly. And so there's a lot of familiarity with it. I would say just beware the bait and switch, right? If you're cautious about reacting to emails and online messages promising incredible offers or tax refund opportunities, good for you. It is prudent to be careful. But if you dismiss ERC as being too good to be true, you may miss out on a significant refund that requires minimal effort to collect. This is what I would not recommend doing on your own. I would suggest you locate a reputable firm to determine whether you qualify, and then he will also complete the calculation for you if you do.
Yeah, I mean, Gerald, just to jump in from like the point of view of as a CFO or business owner and my clients, like the reality is nobody has a team that has extra time. The reality is everybody's teams, their corporate, administrative, finance, accounting, management teams, they're already busy. I mean, so these are great opportunities that quite frankly go to an expert, talk to Gerald, but it doesn't cost a huge amount of money to take a look at these. And then you want to have an expert do this. You're dealing with government on almost all of these. So it's a bureaucracy. There's a certain way to do the forms. And then if they do have questions, the experts look at this every day and they know exactly how to answer whatever their quest is. Whenever a corporate team tries to do this, more often than not, it ends up getting pushed to next year, which is just lost money. I mean, if anyone has a corporate team that's not exceptionally busy, please let me know. But sincerely, it's like everything else that requires expertise and experience. It just ends up being so much more rewarding to have the experts do it, and you get that money as fast as possible. That's my sincere experience. And there are, as Gerald said, you can talk to Gerald, and there's several, service providers for each one of these. So it's not that there's only one. You can talk to 2 or 3, but I would not try do this in-house. And in my experience with my clients, R&D, for example, is one where I over the years several times the manufacturers say, hey, let's look at this, and they immediately have that reaction of, oh, we don't have any white lab coats and beakers, doesn't apply to us, not going to waste So again, it's just, there's an educational component here. It's just better to bring in an expert, in my
No, I think
experience.
that's exactly right. We've had a number of CPAs, for instance, who started doing some of these things and said, you know what? One, we're going to miss some things. Two, we really don't want to have this risk in-house. And three, we're spending so much time on this, we're neglecting what we're supposed to be doing for our clients. So they begin to look externally to have someone do this for them.
And the risk is a great point, because why do we hire tax experts to do our income tax returns or our franchise tax returns or sales tax? Because if there is something for whatever reason doesn't quite work out right, that expert's, ultimately responsible and will intervene and resolve it. Whereas, yeah, if it's in-house, it ends up, next thing you know, you're having team meetings and board meetings about something that really, quite frankly, it where it should be.
That's right. Isn't that your core competence? That's right. Awesome. So this is a disaster retention credit. We call this a disaster tax credit. It's been around since 2019. Click on that. Been around since 2019. Has been updated and expanded almost every year. Brings business owners about 2,400 a year per eligible employee. So disaster, think of, when we look across the country, California, it would be the forest fires, mudslides.
Yeah,
Florida.
we have an attendee here today with us from California, so worth spending on that.
Good. Well, again, California would be some of those disasters for that region. Florida would be, hurricanes. In our area here, in the Texas area, would be tornadoes and straight winds. But there are currently over 280 counties that are eligible for this tax credit. That expands every year. Now, so quite a few areas. We want to take a look at a sample company in a little bit. We'll look at a real case scenario, but actually, before I do this, these are 6 of our top flagship headliner tax incentives, but there are a number of credits that are also available. So just starting with locations again, we also look at qualified zone tax credits, federal historical tax credits, state historical tax credits, rehabilitation credits. We get involved in 1031 exchanges and many, many more.
Just quickly, for everybody, the other ones are sort of intuitive, almost from the title, and for historic real estate properties. Opportunity zones, yeah, is worth a webinar of its own. But what 1031 exchange, for the folks that aren't, so involved on a daily basis with real estate, what is that?
Just quickly, if you want to exchange a property, instead of selling it and then paying the capital gains on it, typically what we see is that property is exchanged for a larger property, and the tax is moved to that property. So you don't have to pay the tax on it now, you can defer it.
Okay, so the tax is deferred. Great, thank you.
Right. And then on the employee side, there are a number of other incentives. Some of the top ones are the architectural and transportation tax credit, empowerment zones, job creation tax credits, and many, many more. So the important thing is you don't want to miss, nor do you want your client to miss anything that they might be qualified for. My family, we enjoy movies. There's a 1990 movie, Pretty Woman, with Julia Roberts and Richard Gere. I'm probably telling a little bit on my age on this. But at one point in the movie, Julia, in her character, she has a pocket full of money. But the sales girl just refused to help her because she just doesn't look the part. And I don't want this to happen to you or anyone else.
Yes. Big mistake. Big, huge.
Don't miss out. It could be a big mistake, big, huge. So let's look at that sample company for a moment. Now, this would be a manufacturer, has 50 employees. They hire about 10 people a year. Maybe they have 2 facilities that they own or made significant renovations to, and we have a sample city here as well. So when we look at this, let's start with those location-based incentives. So again, cost segregation, this potential client could get $288,000 just for owning the building. We do a property tax review, and there's some reduction there of $24,000. So we're going to tag that on and see it starts to add up. On the employee side, we're going to look at their employees, not just the ones that work for them today, but the ones that have worked for them over the last 4 years. And for that credit, starting with the R&D tax credit, we spoke about a few moments ago, $161,000, pretty decent in my mind. Moving on to what I call WOTC, that hiring tax incentive credit, about $12,000 a year. And then COVID, right? That's when we get into the millions of dollars potentially, right? And then that disaster, that location-based tax credit. For this sample employee, we'd get another $120,000 a year. So it gives us a grand total for this potential client of 1.9 in initial benefit. Now, you can say, Gerald, listen, my client, they already received the ERC tax credit. I say, listen, that is awesome. ERC and PPP have been a huge lifesaver the past 2 years.
Literally.
Congress didn't renew either program this year, but they did add 2.3 trillion in programs like ERC. So are you open to talk about the other 300,000 in employee-based incentives, or the other 300,000 in the property incentives? Listen, missing out on $600,000 in cash flow is a big mistake. Big. Huge.
Yeah, especially when, as I, always remind my clients, so you want to give your competitors $600,000 each over you. Because if they're applying for it, they sure as heck aren't going to be telling everybody.
That's exactly right.
So, like, if you want to truly maintain your competitiveness, and for manufacturers, I mean, right, ultimately, cost is a huge part. You're, in my opinion, you're crazy not to look at this. And also, what I explain to my clients is R&D, for example. Okay, the first time around, yeah, it's going to require some management time. But once, by year 2, okay, you now got the model, you can understand how it works. Okay, these things change quite often, so you gotta have your service provider keep you abreast of that. But basically, once it's in place, it's not as much energy each year to maintain it. So I think often it's just keeping that perspective that, oh, hey, this is not just some other big project we have to do every year. No, it's a reasonable project with a good probability of payback, and if not this year, perhaps next year.
That's right. And I'll tell you on 2 things. One, you're right. If a company is taking advantage of these things, it really can become a strategic advantage going forward for them in their industry. Exactly right about that. And in terms of capturing some of these things, again, most firms, again, are focused on the large multinational Fortune 1000 companies that do this. Like us, our market really is small and middle market companies. We understand who we're dealing with. They don't have management time to get out of their core process. So we do the heavy lifting for them. So we've designed a process that, one, we can capture the incentive, but do it with minimal investment time from management. So great points on both counts.
That's what we need.
Now, we'll take one other response I get sometimes is, Gerald, hey, I just don't believe in free money. And listen, I can respect that. Listen, I prefer to earn versus being given something as well. So at one point, I felt the same way. But then I realized, like we're saying, that some of the largest companies in the country have been taking advantage of these existing tax and incentive programs and techniques for decades. Why shouldn't the little guy and gal, the mom and street business owner, the ones that really need help, why shouldn't they utilize some of these existing programs as well? I mean, I would say owners, they're not utilizing these existing incentives at alarming levels. And remember, we aren't creating something that's not there. We're simply optimizing existing programs in their business because they invested in property. they employ people, right? So I mean, each person has to make their own decisions, but I can tell you, I was at the
Yeah.
CPA friend not too long ago, and without prompting, over breakfast, he said, Gerald, I would much rather be the one presenting these ideas to my clients than them suggesting them to me. So, I cut you off there. You were about to say something there,
Well,
Andrew.
I echo very strongly what you're saying, and I listen. You know, I respect that as well. That American entrepreneurial attitude of, you know, I'll work for it, and my, you know, if I have a successful business, the business will generate what's necessary. But I would say this. I mean, first of all, none of this stuff is free, right? It's coming from your taxes and from your business taxes. So that's number one. It's not. This is not charity. This is quite frankly money you've already paid that for whatever reasons, different level of government, federal, state, local, et cetera, have determined that they want you to remain competitive and perhaps to stay where you are, right? I mean, things like real estate, the property tax incentives. Well, if that's helping you help them maintain that community, I think that's noble. And as you said very well, listen, all these names we see on the news every week, Amazon, right? Tesla, et cetera, et cetera, et cetera, including companies that aren't even from the United States, right? And I love working with international businesses, and they should take advantage of these things the same way American companies do when they go abroad. But you're really, I mean, the modern business ecosystem, you know, provides these things. I would say, you know, as long as you're working with an expert who really knows the ins and outs, you're providing the information honestly, why wouldn't you want to? You know, I strongly insist on that, especially think of it as it relates to your human resources, right? A lot of businesses, including manufacturing, can be very cyclical. Well, if you have this kind of support, it may enable you to not have to lay off quite as many people when it's a little slow. And what does that do? Okay, you're a little slow with the same team. You're giving better service than ever, hopefully, right? There's some efficiency gain there for you. So try, don't be so overwhelmed by these fast. I mean, some of these are new to me as well. This is an awesome cornucopia of incentives. But you know, take a couple steps back and think, okay, strategically for my organization, this may mean I can, if it gets a little slow, I can keep people on the payroll, and then there's benefit to that. So I insist it's worth some thinking about. And maybe for your organization, it just we've talked a lot about manufacturing. There's a lot of that in California, Texas, et cetera. You know, maybe hey, listen, we're not going to jump into this whole thing, but R&D, yeah, let's look at that. There's a lot of value in being proactive with these, because sticking with R&D. Okay, we don't qualify this year, we don't qualify next year. But we're looking at it every year, and then in year 3, when we've actually got to make some significant changes to our processes, which you mentioned a couple already, Gerald. Well, hey, we definitely qualify in year 3. So I find that many business owners tend to be frustrated because, like, oh, I should have done that then, and then they sort of say, well, I'm not going to apply now. That's not the case. And like everything, these things are always evolving. So for something that we're not even thinking about, you may not qualify this year and you end up qualifying next year. There are sometimes counterintuitive factors in these programs, because ultimately right there, they are a bit bureaucratic. So well worth my.
You're right on point there. I'll tell you, we were referred by a business consultant to one of his multi-generational clients, manufacturing firm. And they were referred to us primarily for ERC. So we're having our meeting, our discussion, and the CFO is explaining to me, kind of, here's what we've done before, here's what we're doing now, here's what we expect to do going forward. And as we're having the conversation, I chimed up after a while, said, listen, I know that such and such referred you to us for ERC, but it doesn't sound like you have you meet the criteria for that. One, you weren't shut down for any reason due to COVID. If you qualified, you were shut down, we could probably get you qualified on that criterion alone. But absent of that, we're not seeing the impact to revenue. In fact, year over year, quarter over quarter, your revenue has grown. So that doesn't sound like you're going to qualify for ERC. However, it does look you qualify for another 1.9 million in other incentives. Would you like to have a conversation about that? What do you think his response was to that? So you're exactly right. One of the key things to ask, I think, is what would this mean for you? Or as an advisor now, what would this mean if you guided your prospective client to this level and to this type of cash flow? What would that mean for you? What would that mean for your business?
So Gerald, a question, right, from the perspective both of my own and of the business owners and business managers. So working with you in Snapshot, you have some kind of data request, and then with your custom proprietary tools, sounds like you do some initial analysis that says, okay, yes, no, maybe. Is that the case?
Absolutely. We can have a conversation over the phone, virtual, in person, and very quickly in that conversation, we can help them determine not only what are some of the areas they should explore, but what the potential impact, dollar amount in each one of those areas. And we can do that. We call it the guided assessment. We can do that in 15 minutes. Often those meetings will go, a little bit longer than that because they have questions. But very quickly, we can assess whether it's something you ought to consider or not consider. Absolutely.
Okay, great. Yeah, because it can be a little intimidating, like especially if, especially the first time, like, wow, this is a little overwhelming. But like, again, you've just confirmed it, like from one conversation around one data package, so to speak, you can quickly evaluate, get a good quick evaluation. Okay, yes, no, maybe, and then drill down where it needs to be. So this is not as overwhelming as an audit, folks, or something like that nature. If you have good financial reporting, you've already got most of this information. I would say you may there's other things you may need to prepare, but you're going to have enough that Gerald, for example, could perform that initial evaluation.
Absolutely. We've been doing this a while, so we're maybe a little bit ahead of most, but we have proprietary software that we use. So with us, I can tell you, it doesn't take as long as you think it would take to determine what those are, what those areas are, and then certainly they engage our team to actually capture these incentives and cash flows for them.
Thanks.
Good. Now, just real quickly, we're talking about some of this. How do you accomplish this? And I'm sharing this, how you get accomplished this and how you might go about it. Someone may try to go about doing this alone. These are going to be your results. If you want to piecemeal it together with different industry vendors for some type of cohesive approach, these are your results. Should you be relying on your CPA or, God forbid, take a call for one of those ERC, marketing firms calling you 10 times a day, these are your results. It's going to take a while, and this will require you managing it. But here's kind of the timeline or some of the industry norms for this. For WOTC, that higher tax incentive credit, the biggest player out there, handling one of every 5 or 6 payments out there. Again, we're looking at $1 billion a year in WOTC tax credit, and that's not significant for that amount. That's less than 1% of market effectiveness there. Cost segregation, once you engage, you're looking at 3 to 9 months to get that cash. Just to coordinate the schedules for all the involved parties for just the initial site visit is going to take you 6 weeks. This was just confirmed to me by a CPA not too long ago. For R&D, again, there's some good firms out there. You're looking at 90 days plus from what we're seeing and hearing. COVID ERC, 30 to 90 days for that, actually more like 60. The location-based incentives, don't know anyone else is doing it. And for property tax, as though owners have for years pounded the table that they're paying too much in property tax. They probably are. In many cases, they're right. It still isn't executed as often as you would believe. Now, what we would suggest is having, if you're going to do this, is having a system, having a platform. One of the benefits of using a platform is the stacking of incentives and credit. So with a platform, true benefits, you can have something that works together. So to give you an idea about that, let's look at the life cycle of a client. One, cost segregation. For the last several years, we've been averaging 2 to 4 weeks to get money in client's hand actionable. We can do this almost instantly now. R&D, we're looking at 60 to 90 days after that. Another month, 3, we're looking at COVID ERC, capturing that. Disaster, another 90 days. And for property tax, most municipalities do this once a year. So maybe this could be in a month. If they're, if that's when they join our platform, maybe it's 11 months and 29 days. It just depends on where they come in the cycle. But all of this just continues to feed your business, your services on a continual basis. So again, missing out on the opportunity, this could be a big mistake, huge.
Yeah.
And just slip that in there. So I know we went through a lot of information. This is just a quick break to regroup and look at that cute puppy. But we're not done yet. This is specialized tax incentives. This is one slice of the pie. It's not the whole pie. So I'm gonna move through this a little quicker, but our research shows that 75% of business owners are not minimizing service expenses. Now, we say with Gerald, we watch our costs, and I'm sure you do. However, I'm referring to independent third-party audits without changing vendors, and not you're a broker who is presenting you with current market quotes. The right audits are profit-enhancing tools that make this a quick and easy win for you and your clients. Huge opportunity to bring more value to your clients. So just a couple examples. Workers' compensation audit. This is a third-party independent audit that will go back 5 to 7 years. It identifies and recovers worker compensation premium overcharges. So we've learned that risk classifications oftentimes start out a bit loosey-goosey. Just over time, they just get out of whack. And over 70% of companies have been or are currently overcharged for their work compensation premiums. Merchant processing. The Restaurant Association is lobbying the state right now to increase competition because rates have increased 3-fold for restaurateurs, and they're not the only ones. It can be incredibly challenging to comprehend how they're calculated, and they're sometimes shrouded in mystery. These fees frequently have mistakes and overcharges as well. If you believe the IRS, and our experience does bear this out, businesses are overcharged $70 to $80 billion a year for inaccuracies and erroneous errors. And then we do similar work in the waste and recycling area, as well as postage and shipping. Again, neglecting this slice of the pie for you or for your clients is a big mistake. Big might be huge. And I'm throwing a lot of information now. We've got a little bit more to cover, but I really have a 1-point message here. And it's really just to see if you are open to considering other ways to improve your cash flow.
So Gerald, just quick, I mean, these again, it could be a whole nother webinar on these, but postage shipping, is that, I mean, could you just tell us a little bit about that? Give us a little teaser, a bit more information on the postage and shipping.
Well, think of all companies that ship by UPS or FedEx. There are a lot of overcharges and accuracies in that space. So we go back again, working with whoever their current vendor is and negotiate with their current vendor, no changes required. And out of the actual savings, then we share a little bit in the benefit with the client. No benefit, they don't owe us anything.
Okay, great. Thank you.
But again, third-party audit. Moving on, stacking. By stacking some of these strategies together, I alluded to this a little bit before, you can have a larger impact than each one on its own. And just quick about this, I'm a little off script here with this, but just to give you an idea of what this means, that, for instance, PPP and ERC, when those came out, they actually came out together, but you had to choose between one or the other. PPP was a loan incentivized program to keep employees on. ERC was a tax credit, tax incentive credit to keep employees, employed. Now, if you're familiar with both of those, if you were, like we were, we had many clients who chose to go with ERC as opposed to PPP. Because one, even though it was a low interest loan, you didn't have to pay this back, right? You didn't have to worry about forgiveness. And in many cases, you could get a magnitude more with ERC than you could with PPP. Well, later on, rules started to change, and now you could actually have both. Well, if you were still looking for cash influx, you could also get both of those. Now, since they were both based on wages, you couldn't double count them, but there was a way of maximizing what you could get from both of those. Now, just having the expertise in one or two areas, you can start to see the benefit of that. Now, look what that looks like over hundreds of different incentives that are available. If you're a client, certainly you can see the benefit of that. If you're an advisor, does now your client or potential client look at you as average run of the mill, or did you just level up, boss level for the gamers in the room? Yeah. That's the difference of stacking.
So we have a question from an attendee. Thank you for the question, Patrick. Can you give an example, a case study almost of savings from using those third-party vendor audits, maybe from one of your clients?
Sure. I have to tell you more. One recently was a restaurant group, for instance. Again, we all have our favorite restaurant. Most all of them are paying by transaction costs. This was a restaurant that had less than 10 locations.
Okay.
We engaged with them, and somewhere between month to month it changes, but somewhere between $2,000 and $3,000 a month in savings back to the bottom line for them. What was really interesting about this case is they have a group of restaurants. There was another group that they had kind of referred us to, and they decided to go it alone. So they didn't join us at the time. As they look back over what happened in the past 12 months, our client called us and said, you know what, it took some work to get that started. But now looking back, our other friend that didn't join us, they're actually paying a third more in credit card processing than what we're paying. And now that client has reached out to us, or that potential client has reached out to us for us to engage in that area.
Yeah, this is a good case study, folks, because, putting on my CFO kind of CPA hat, when business is booming, quite frankly, management just says doesn't really matter much right now. But when business slows down, and here in obviously in North Texas, DFW restaurant business is again booming. But when things slow down is when it's the death of 1,000 cuts, and all these expenses that we are living in inflationary times. When not that things are bad necessarily, but when things aren't booming, you don't think things come down to a more normalized level, or if there are some industries, commodity-based industries are definitely, they believe they're in a recession right now and dealing with stagflation. They're also dealing with inflation. It's that's when you a great example where the two companies in the same industry, where it's like, wow, we wish we had done this, because when your margins are getting tighter, so often, quite frankly, again, thinking as a CFO, they don't really shout at you that they're raising your prices, right? Often it's hidden in some fine print, or you don't notice till you look at the invoice. So again, it pays to be proactive, and as your client said, okay, it took a little work to get it set up, but then it's another ongoing process. It's really a matter of in this case, those restaurant groups getting to you on a regular basis that information. Then it's it may change, but very good companies will be very glad they did it. Yeah.
Right. Let me move to a real example, very segue. This is a Texas manufacturing firm. They were referred to us by an engineering consultant. So looking at year one, some profit enhancers from work comp and merchant processing. For the employee base or property-based incentives, gave us another $300,000. R&D employee-based incentive north of $180,000. So first year, nearly $600,000 in cash inflows. Year two, the property tax savings came into play as well as that location-based credit, resulting in nearly $100,000 in cash flow in year two. Now, the projected recurring tax savings from hiring tax incentive credits from R&Ds projected at north of $100,000. Now, don't miss this part here is if just looking at some of the categories here, if 92 of every 100 property owners haven't had a proper cost segregation study, if a high percentage haven't taken advantage of the employee incentives on the far right, the hiring tax, for instance, less than 1% are using those effectively. And if over 7% are not taking advantage of these profit boosters, what does that suggest to you about the impact you can have for your company or on a strong percentage of your clients or the client that you want to have?
Yeah, I didn't. Time flies when you're having fun. I can't believe it's 5-1. So I'm glad you're hitting the summary. And I add to that. I'm going to even push it harder. With many things we've seen, in the last couple of years, a lot driven by COVID. There's been a lot of wake-up calls, and I know we're all busy, right? Business owners are busy. Management teams are busy. Boards should be busy, but hey, I'm sorry, board members. If it's not, it's ultimately, you have to do shared responsibility to make sure this is at least, these kind of things are at least being looked at, because it's too important not to. And, we've seen a lot in the last couple of years, so many issues of risk management and working virtually and how all kind of issues around data. And this is going to be something else where I can see in 5 years, right? It'll be another one of those things like, wait a minute, how come the board never, how come this never was suggested to, the board? How come, vice versa? How come, if it wasn't, how come the board never asked about it? This is clearly material. I mean, even if you're a $50 million revenue or $150 million revenue business a year, you're talking about even $250,000 cash flow net that you already paid in taxes coming back to you. Don't tell me don't tell me that's not work.
That's
There's
exactly
a fun, responsibility here. And ultimately is the management's responsibility, and we're all here as experts to help them. But yeah, I mean, very well, very, very nicely laid out. So Joe, we've actually had the last couple of minutes. If there's no more questions, if there's any more questions, please put them in the chat. Hey, it's sometimes right after the webinar's over, you think of 1 or 2 good questions, just go right ahead and email them to us. We covered a lot here. Great job. I mean, this is a whole universe of incentives, Gerald. Great job making it bite-sized that we could understand it. But any questions, you can reach out to Gerald directly. You have his webpage. Happy, you can email us. We're both on LinkedIn, so happy for questions. And we're happy to do a follow-up webinar on drill down a bit on things you find most valuable. Joe, do you want to show your page again? Your what's your web page? They have it. I'll put it in the chat. Yeah.
my last slide.
Okay. Time flies when you're having fun. I learned a lot on this as well. It's important to stay on top of this stuff. So it's www.snapshot.
Yes, snapshotbusinessservices.com.
Okay.
And again, feel free to reach me on LinkedIn, website is probably best, or give me a call. I'm open
Yeah, and
to
I'll
conversation.
send out an email follow-up with the replay and include Gerald's information. Thank you all of you for joining us. Thank you for the questions. We'll keep these webinars going this year. Joe, thank you so much for joining us. This was great for me as well. It's it's fascinating and then great to learn that there are things our governments are doing to support our small and middle market businesses. This is Andrew Barker at Middle Market Advisory, fractional virtual CFO and CPA. So likewise, if anything I can do for you on my side of things, happy to have a conversation. Thank you for joining us. And thank you so much, Gerald.
Thanks for having me.
All right, everybody, you have a great rest of your day. We'll see you on the next webinar. Bye now.